Hello and welcome to our show, KPMG, The Blueprint, Business in the New Normal. Well, today we're discussing embracing digital transformation, the growth of tax technology in India and beyond. Well, we all know that technology plays a crucial role in all business functions, including tax. Now, tax technology is a term coined for technology solutions which are catering to taxation. Though the concept is relatively novel, it has become very popular rather quickly. This is due to the significant benefits that have accrued to all stakeholders of tax technology, including enterprises, governments, as well as tax consultants. Well, while some countries, they're still catching up with the technology spurt in the taxation domain, others are quite ahead in terms of using as well as adopting technology in tax-related functions. India, on the other hand, has been on top of technology developments, and private firms have been responsible for bringing the best-in-class tax technology solutions here in India. Businesses also have been quick to adapt to these new, improved solutions. COVID-19 has only further accelerated this adoption and has driven businesses to rely more on technology as well as digitalization. This is due to the fact that the lockdown taught businesses to work remotely and use technology extensively for smooth functioning. Well, today joining me on the show is Rahul Kashikar, who is Partner, Head Tax Technology and Transformation and Corporate International Tax at KPMG in India. And we're going to discuss the growth of the concept in India, its impact on taxation, and how the roles of related parties have evolved through technological progress. Welcome to the show, Rahul.
Thank you so much for having me on the show.
Well, let me begin by asking you, there is talk of increasing technology within tax. Why do you think this has been increasing, especially over the past year or so?
There are two primary reasons for this. One, governments across the world and in India have adopted technology for tax compliances in some form or the other. 60 plus countries have now adopted e-invoicing, including India and Brazil, and almost all countries will move to e-invoicing in the next 10 years. So in simple terms, e-invoicing is basically a mechanism where every tax invoice is required to be registered or validated through the government's IT system. Even statutory tax filings are getting online, and they require a lot of voluminous data sets to be filled in. In the past, all of this used to happen manually, but now companies are finding it really challenging to manually comply this with such statutory requirements. So they really need to use technology in each of the compliances that they do statutorily. So let's take, for example, e-invoicing. Now, if you have 100,000 invoices to be generated through the e-invoicing mechanism, doing this manually is going to be very tedious. In fact, to deal with this, now companies have started integrating their entire e-invoicing system with their ERP systems, and they are able to completely automate the end-to-end process, which is getting a significant amount of efficiency and accuracy for them. The second reason is that governments have started using technology to match data across different tax filings. For example, in India, the data in tax filings for GST is now matched with the data in income tax returns. So tax administrations are now able to review line by line transactional data due to technology. Now, this creates obviously a growing responsibility on companies to improve the data quality for their tax filings and the ability to respond to tax departments' requests to reconcile the mismatches of data. If companies continue to do this manually, then they are going to need significantly more resourcing to meet the timelines. Also, remember, these are statutory requirements, and any delays can lead to penal consequences. So with this evolution of technology within the tax administration, more and more companies are now talking about technology within the tax function.
All right, Rahul, noted. Let's get to our next question then. What are the areas in taxation domain where this technology can have a significant impact?
Currently, there is significant focus on using technology for GST filings. This is a basic statutory necessity created by the government. But technology can have an impact on every process of tax, which involves significant amount of data and documents, whether it's before the tax filing or after the tax filing. Let's look at some examples where they have a huge impact. One, tax deduction or collection at source is an area where tax is required to be collected or deducted on each purchase and sale transaction of a company. Now, companies are finding it challenging to reconcile and claim their entire taxes deducted at source on income. Due to this, there is also a loss in income tax credits, which is actual real loss for them. With the use of technology to reconcile and monitor such credits, companies can not only improve their processes but also bring about real cash savings. Even on TDS on expenses, companies are now already building automated controls and reports within the ERP system. One such example is automation of clause 34A of the tax audit report within the ERP. With automation within the ERP, the reports which took weeks can now be generated in a few hours without much effort and with much more precision than what used to happen earlier. Building such automation in the ERP helps to actually minimize leakages by tracking these transactions line by line at source level. Another good example is TDS on dividends paid by listed companies. Listed companies are paying dividends, and some companies have lakhs of shareholders. Taxes are required to be deducted on almost each shareholder, and the rates depend upon the type of shareholder. So, tax specific algorithms are built into data automation tools to validate the underlying data and tax rates for each shareholder. Even statutory forms such as Form 15 CACB generation is now being automated. With the volume of data to be processed in a matter of few days, the use of technology is absolutely imperative for such processes, Nigel. Even tax assessments have become digital and faceless. Implementing technology to govern the readiness for such assessments is equally important. Also, with GST audits coming up, there is always a concern with finance executives whether the GST transactions recorded in the ERP systems are compliant with all provisions of GST. With GST specific data analytical tools and algorithms, it's now possible to conduct a health check on line by line transactions in a matter of few hours. While several companies have started in a small way to use technology in tax beyond GST, I think there is still a lot of optimization which can be done using technology within the tax function.
Well, got that, Rahul. But how do you see the industry in India adopting to technology within tax function?
Clearly, Nigel, in India, the government is ahead in implementing technology for tax administration as compared to the industry. India's GST network is a one-of-a-kind technology-driven system. Even within direct tax, almost every process is now automated by the government. For the industry, however, it is still early days and it's evolving. Not all companies are going beyond e-invoicing and GST compliance. I think a lot of focus in industry is still going towards automation in finance because obviously the cost savings are huge in that field due to the significantly more activities and processes. Also, tax has significant amount of regulations to be built in and that much more challenging to automate. But technology in tax is now equally important because of the statutory nature of taxes. It can actually help to bring accuracy and speed to respond to any tax queries or increase the accuracy in the compliances that an organization does. And this way, there is a significant amount of reduction in the risks that a company goes through. Let's look at, for example, GST audits and faceless assessments for income tax. A huge amount of data is needed to be submitted during such inquiries, and technology will be absolutely imperative being able to provide such data during audits. We are seeing that even within GST, now technology is being used beyond GST compliances and filings. In fact, some companies are using GST to manage cash flow blockage arising due to incorrect reporting of GST input credits by suppliers. It is possible to build automated controls within ERP systems to block payments to suppliers if the GST charged by the supplier does not reconcile as per the records maintained by the government for that supplier. Companies also need to provide evidence of backup documentation for services rendered by overseas group companies. The process of collation of such documents can also be automated. Even the process for cost allocations is being automated routinely now. So, if you see, all in all, there are various areas in which automation can be adopted by a company, and it depends upon the specific circumstance that a company would like to automate at each given point of time.
Rahul, as a CFO or tax head of a corporate enterprise, what should my first step towards tax technology be?
So, Nigel, as a leader of the finance or tax function, the focus should be on 3 points primarily. First, on the why. Why should you use technology in tax? The reason should ideally be to improve accuracy and efficiency in the tax processes rather than purely cost savings. Second, on the where, i.e., which processes should technology be applied in tax. The first preference would be to look at transactional taxes such as GST, TDS, TCS, since there are chances of human errors in transactional data processing. Also, repetitive processes should be reviewed for potential automation. The company should also ensure that it has robust digital tax governance processes where the finance and tax leadership is able to digitally track all tax compliances, tax proceedings, as well as retrieve all tax documents required for any future tax proceedings. Now, the third part is the how to best apply technology within tax. And this is a tricky part. Why? Because off the shelf technology tools may be available for some use cases, but the outcomes of accuracy for the finance and tax leadership will be entirely dependent on the quality of the source data, on the ability to change the algorithms in the technology with frequent changes in regulations, and finally, also whether the tax teams have sufficient experience in dealing with each provision of the tax law. In our experience, every company has a different way to recording transactions in the source accounting and ERP systems. And hence, the current state of data and the adjustments made in the ERP system will not allow technology to provide expected outcomes until the source data process is improved. Also, because of the change in regulations and the need to constantly be updated on such regulations, companies are now evaluating whether to automate within its own environment or work with third party service providers who can deliver the tax outcomes using its own technology. The final decision actually depends on whether the organization would like to build its own function with automation or use service providers to leverage technology outcomes for tax processes.
Well, the possibilities in tax technology space are endless. One needs to be agile and have the willingness to evolve as and when needed, even if it is on a daily basis. Well, tax technology could prove to be the foundation of a sustainable tax compliance space and give competitive advantages to organizations. Now, if one looks around carefully, it can be easily understood that technology is not a value addition anymore. It is now at the core of each business function. Well, with that, we have come to an end of this discussion. Thanks so much, Rahul, for sharing your thoughts as well as your insights with us.
Thank you, Nigel. Pleasure talking to you.
Thank you for watching KPMG, The Blueprint, Business in the New Normal.